Morning, everybody.
Morning. Good morning, Cam.
Morning, Alex. Morning. I hope everybody is doing well on this lovely Wednesday morning.
Morning.
Really excited to have all you here.
Cheers.
Got just over 50 people already that have joined, so a few more should be coming through. But it's an exciting time to have you all here for something that's a little bit different than what we used to for Cinnabar's quarterly webinar. Normally we have a presentation or an interview from some high profile guest speaker. But I thought that given that all that's happened over the past months, the whole year as a whole, actually, I think it's important to have a setting like this because this year already we've had budget 1.0, then 2.0, and then 3.0, and that's finally started to get a little bit more support from within the GNU. But we've had Trump and his tariffs, and as a result, no one really knew where inflation was going. Neither did the Reserve Bank or the Federal Reserve, and so it's been a little bit more cautious. But the markets, as they do, react quite volatile. There's been a lot of noise coming out from major news stations, and so that's kind of made a little people quite a bit anxious. But what's often needed in times like this is a calm and considered thinking that's going to help you as an individual, but also as an advisor, figure out a way to make informed choices and stay away from doing any emotional ones. And so that's why I'm very happy to present that we've got our entire investment committee joining us here for today's session. We're going to be giving you a behind the scenes look at how we think, how we actually manage money, but also give a platform for you to ask the questions that are affecting you on a day-to-day basis. And so that's going to be hopefully be quite a useful session for you. So with that said, there is a Q&A bar down below. If you have any questions, please put them in there, and then we will get through we'll address them when we get to that. So yeah, please pop in as many questions as possible. I know there was an invite link and that had some questions, so we've got a few of those to run through as well, which I'm looking forward to. But I think without that, let's get started. I did say there wouldn't be a presentation, but I think it is important just to a quick little update on Cinnabar before I get you into what you're really here for, which is to chat to the investment committee. Probably the most important work we've been doing over the past quarter is not necessarily, or past year almost, hasn't necessarily been about our investments, about making them stronger. It's about why do we exist? What is our purpose? And so we used to be to create and protect intergenerational wealth, which is very correct, and that is still what we do. But it's about our true goal is playing our part to make sure that we are empowering clients to achieve financial freedom so that they can choose what is important to them. So it's no longer purely just we meet your return goals. We're trying to play a part of this bigger puzzle to make sure that they can choose what is important, because financial freedom doesn't mean the same thing to everybody. And so that is our guiding light when it comes to how we operate internally, as well as the decisions we make through investing. But I think it is important. Give a quick little performance update. So this is as of the end of last week and how we've done relative to peers. And it's very pretty. Obviously, green is your first quartile, so top 25% of funds. Red, which we thankfully don't have any, is the bottom 25% of funds. And so what we've been able to produce through this process and this robust investment committee that we'll have the pleasure of speaking to today is we built a investment offering that is competitive, that achieves what it's supposed to do in terms of returns, but also focus on making sure that your risk is diversified and so that you aren't blowing up anyone's retirement annuities. That's truly our goal here. And so on the local side of things, numbers are looking good. And then offshore, we see that performance is really good. Over 3 years, we're in first quartile in the global balance. And so for those of you, the keen eye, who have been part of Cinnabar's community for a while, know that we've also launched a global equity fund. And proud to say that it's still performing incredibly well relative to one of the toughest benchmarks to beat. It's done just a 5.45% over the past 8-9 months. Only slightly behind its benchmark, which is the All Country World Index. But I mean, it's a short-term fluctuation. We see over the first 9 months of this fund, we were outperforming. And so we're still very proud of this fund, and we still continue to work on it to make it a little bit more robust. I do think my last 2 slides are to mention that it's not necessarily by luck or hope. What we do is we're making sure that we're building portfolios that are robust in their design. So we incorporate numerous asset classes to make sure that the end investor has their long-term allocation to the various asset classes, right? And so for balanced investor, so if you invest into Cinnabar balance fund, this is what the kind of breakdown that you'd look at. But it's important to say that it's a little bit further than it goes a little bit deeper than just the asset classes. Being a multi-manager, and that's where we find most of our value. You invest into the balance fund, what you get is a huge suite of investment capabilities. And so you have lots of manager diversification, but also you're getting this most skilled managers at targeting specific regions. So they're going to try to create little bits of alpha to outperform. And so the whole structure of the funds is to make sure that we are building diverse portfolios that over the long period or over the specified period of time achieve the returns they want to. That is it from me from the presentation. So you'll be happy to see that you'll only see my pretty face and Alex's as well. So I mean, some would say it's probably prettier. But yeah, I think let us get started with our introduction to the IC member. So since Alex is already there, he's the top dog, the head honcho, my boss. So I have to obviously introduce him first, otherwise I'm going to face the consequences. But Alex, in his own right, this is the CEO of Cinnabar, but has 25 years in the industry, and truly has been a driving force behind our group's mission, which is, as we've gone through now, to help as many people as possible achieve financial freedom. So welcome, Alex.
Thanks, Cam. That comment was appreciated. Thank you.
All right. Next up, we have Jeff. Jeff is the head of Cinnabar's investment strategy. He is also a CFA Institute member, almost 30 years of experience in the industry, and has got a broad catalog of experience. And so he's been the head of multi-manager research at Investment Solutions, as well as the managing director of Canada Asset Management. So a long time in the industry. But a little fun fact about that stoic man you see on your screen now is that he was once a professional bodybuilder. And Jeff's offered to if you send him a personal message, he'll send you some of his photos of him in his prime. So
That's
if he
very
doesn't,
kind.
I will. I can.
It's very kind of you, Cameron.
All right. Next up, we have the last of our internal, which is Carl. Most people use ChatGPT or Grok to find out anything that they could possibly need. But the secret is we have a Carl. Carl is our macro guru, knows everything about anything and into an incredible depth. At 26, he co-founded and listed his first asset management company, PSG Escher Multi-Manager. Since then, he's gone on to build and lead several investment firms, including establishing a structured products division at ABSA and serving as the CIO at Sasfin. Welcome, Carl.
Nice to be here.
And then first of our external members is Becky. I just want to see if she had some trouble joining.
Becky's on, yeah. There we go.
Lovely. Welcome, Becky. Well, like I mentioned, Becky's the first of our external members that bring a different perspective to Cinnabar. And Becky in his own right is also CFA, completed the CFP as well, and importantly brings over 20 years of experience in wealth management. And through his time at Momentum at Allan Gray, he's gained a very deep understanding of what advisors and their clients face every day. Morning, Becky.
Morning, Cam. Thanks, and morning to all the guests.
All right. And then the next up is Brandon Ziesman. Brandon has a background in accounting, law, tax, and in a dual CFA and Kaya credentials as well. So Brandon is the founder and CEO of Portfolio Metrics, which manages over 100 billion Rand worth of assets. But he has over 30 years of experience in the industry, spanning big corporate as well as building a global business from the bottom up. And very, very excited to have him part of the panel today. Welcome, Brandon.
Thank you, Cam. Good morning to everyone.
Morning. All right. And then lastly, and the newest member of the team, Mr. Adam Balcom. Adam, welcome. He brings over 20 decades of international investment experience. He's worked in London to Monte Carlo to South Africa. He's truly seen the world. He's a qualified attorney and a Kaya charter holder as well, with senior roles at Sanlam Multi-Manager and Alexander Forbes. And his experience in manager research and offshore portfolio construction makes him especially valuable, and especially over what we've been doing since the start of the year Adam's already shown his experience and his influence. And so I can say from personal perspective, I'm learning a lot through him from working so closely. And so I appreciate Adam for joining us as well today.
Good morning, everyone. It's a privilege and I'm humbled to be part of such a credible IC with so many experienced and skilled people, and hoping that I can continue to make a contribution to this team. It's great to be here. Thank you.
No, you definitely will. I have no doubts in that, Adam. That is for sure. All right. So now that we've got introductions out of the way, I think it's time to start the panel discussion. So I think there's obviously been a lot. I touched on it earlier on with regards to everything that's been happening, all the kind of volatility, all the news that's been coming out, the trade wars, the actual wars that have kind of still been rumbling on a little bit. But there's been some constant dynamic changes. Brandon, so I'd actually like to ask you the first question from a more macro view, and as a person who's been in this industry for very long now. Just giving a general sense, how are you feeling at the moment? What are advisors speaking to you about?
I think, Cam, the biggest theme that sort of links it all together is just uncertainty. What you've got is global norms that have existed in the post-war era for 70 plus years, 80 years, that are now being challenged. The US's place in the world, the trends in terms of globalization over several decades. And I think it's just important to, before you actually start unpacking, China and global geopolitics, and is just the role of uncertainty in portfolios, because quite often we sort of see it as an unequivocally bad thing, right? Uncertainty. And certainly that is true from one perspective. And we just need to think about how any asset is priced. So it doesn't matter whether you're looking at an equity security, a bond, or what have you. There are three key things actually that drive a price of an asset. So one is, what do you expect it to give you? Like next year, the year after, 10 years from now, what do you expect it to give you? Now, in the case of a bond, it's an interest payment, a coupon payment. In the case of equities, it's going to hopefully pay you some dividends, and the share price is going to appreciate. But it's not only what you expect it to do, it's the likelihood that your expectation realizes, that it comes true, right? What is the likelihood of it being very wrong? Could it be much higher, much lower, what have you? And markets price in that uncertainty. So something that you're going to get for sure 10 years from now is more valuable than something you might get maybe 10 years from now. So when you see sort of news headlines of billions wiped off the market or what have you, where have they been wiped to? Where did they go? Where did the rands or dollars go? They didn't go anywhere. People just changed their assessment of what they were holding and what it was worth. So the higher the degree of uncertainty in the world, the more downward pressure it puts on asset prices. Now, that uncertainty can come from many quarters, but one of it obviously is the reliance on institutions, the reliance on the fact that governments will continue behaving the way they've always behaved. Now, that is kind of the one negative aspect of volatility or uncertainty. It drives prices down. The positive side, which I think we as investors always need to be aware of, is where your return comes from is that uncertainty. So why do you over the long term expect more from an equity than a bank account? All right. Because assets price for that uncertainty. You need to demand a premium. You need to demand something over and above a risk-free asset in order to voluntarily hold that risky asset. So we just need to bear in mind, if it weren't for periods of uncertainty when markets get rattled, when investors get rattled, this is where our returns come from. And Cameron, you had up earlier your pie chart of asset allocation, and we can see there's a blend of domestic and local and equity and bonds and other asset classes. When we look at how those things are best blended together, we take into account how risky they are and also how they behave relative to each other. So not everything moves in sync, they move out of sync, and that obviously provides the foundations for diversity. But it's the riskiness of those underlying assets that help us form our expectations of what is ahead. So the final remark on uncertainty is that the two things you can try and do. You can either engineer your way through uncertainty, which means that you are protecting your portfolios, or not protecting them, but you are setting up your portfolios for a very wide possible range of scenario outcomes, or you bet on one of those or two. Now, the betting obviously means if it goes against you, you're going to get carted out. The next thing you got to work out is how accurately, it doesn't matter how clever you are, how good your information is, do you really have an advantage that's going to give you something that no one else in the market, all these other clever people have got? And even if you can predict what is going to happen in the world and in economies, can we make the additional predictions what it's going to do to security prices? So two things. Volatility it can push prices up and down depending on what it does. It's also why we get returns. And secondly, because there's uncertainty, don't automatically assume it becomes a bettable dimension that you can win from, because you can lose from it as well. So I've just taken the theme that links it all together without diving into specifically trade uncertainty, et cetera, et cetera.
Yeah, no, it's very true. It's also oftentimes it's a trade-off with regards to, cool, you might be moving out of one asset class to another, knowing that maybe bonds are going to run as opposed to equities. But there's also that you got to know that what you're giving up on the upside, like both might run, but it's which is going to run more, and like at what point to shift. And so it makes sure it kind of relies on a team that is both perspectives that can kind of help you get to the best outcome, because it tends to be that I've got one view, you might have another, but through like collaboration and just talking to each other, you'd find something in the middle that is probably the best or the correct answer. Yeah,
Cam,
I know
Cam,
yeah,
in my experience, when I've engaged with a lot of investors, many have said these words where I want to wait until things are more certain before investing. Now, just to echo what Brandon was saying, by the time things are certain, all returns have gone. So,
yeah. I think it was your colleague Brendan said it, that in times of uncertainty, that's when people want certainty, and it's inherently just never gonna be that way. As soon as everything's certain, they want returns, but uncertainty drives returns, and so it's during these periods where asset managers need to show their value. And so you didn't actually touch on it there, but I'd actually like to go to our macro expert here, Carl.
Yes.
I know we a lot of the stuff that we hear these days is noise, and Brandon, you've touched on it there, that you kind of need to factor in long terms. But the biggest probably talking point over the past year, if not longer, has been the role of Donald Trump. And I know we've got lots of questions from him specifically, about him specifically. But he's been implementing this tariff strategy, and it's got, from my understanding, most of the world kind of confused as to, is there ulterior motives? Is there the reason why he's doing it? Is it purely just to make America great again? I don't know if you'd like to share, maybe. I know we've spoken about this out of this forum, but you've obviously done a lot of research into this. So yeah, what are your thoughts on Trump, and probably what his long-term goal is here?
Well, my views on Trump is he is the natural outcome of where the US sits in terms of its geopolitical place at the moment. Probably the biggest thing to understand is the US basically did a deal at the end of World War II with the rest of the world. Is we will provide access to our market so you can grow, and you will provide us secure, be an ally for us to defend against the Soviet Union. It was essentially, so they did the Marshall Plan, rebuilt Germany, rebuilt Japan, and turned those places into military bases, put NATO together, and pretty much everybody in the world was, you were either part of the US or you're part of the Soviet Union. And as being part of the US, they would basically give access to their markets, the biggest consumer market in the world, for defense. And that all really changed. And I'd say not with the fall of the Soviet Union. The real end of the Cold War happened 3 years ago when Russia invaded Ukraine and was unable to take what was effectively almost a third world country. With all the so-called might of the US Army, all they did was send weapons there, and the Russians failed. And that became clear that the Soviet Union was no longer a threat to the US. Now, this has been happening for a while. The US has been pulling back from the rest of the world to being the world's policeman for a while. And you can see it more and more in their policies. And Trump just took it to the next logical level. I mean, you saw it when Vance went to Europe. I mean, he basically was breaking up with Europe. I mean, as saying, but in typical Trump style, they didn't say, it's not you, it's me. He said, it's not me, it's you. You're fat, you're lazy, pay for everything. But basically, he broke up with Europe. And what Trump's doing is he's upending a lot of, as Brendan said, a lot of things that used to exist the way they did. A lot of the status quo, a lot of stuff that has gone for many, many decades in a row. And the establishment is pretty much appalled by that because it's so against the way they see the world and the way the world's always worked for them. But these changes did tend to happen many times cyclically through history, and this is just the next cycle on it. And there's a couple of other cycles that are happening as well. We're reaching, the limits of how much debt can be had, not just in the US, but other parts in the world. We're seeing that, and I can talk about that if we've got time just now, but how we're reaching the end of the limits of like the debt cycle, but we're really at the end of a political cycle or a geopolitical cycle as well, where it's simply changing the old institutions that aren't working anymore because the institutions, banks, corporates, government have all mixed together into a really big single institution that's no longer working for the world, in many ways. And this, like I said, not just a US issue, it's the same thing that's happening in Europe. It's the same thing that's happening everywhere. I mean, we even see it to an extent here in South Africa, where, you almost have to change the institutions. And generally it takes, whereas they always could be changed nicely, people don't, there's so much inertia to change it that it tends to take somebody coming with a sledgehammer and breaking a whole lot of things, and then they're rebuilding them. And that breaking it of the things up, that's what causes the uncertainty. Now, to say how things are going to turn out specifically is almost impossible because there are so many different routes. We could go a high inflation route, very possible, in which case, being invested in high risk assets like, where they carry on spending money is like, tech shares or Bitcoin or even things like that could really run up. Or we could end up hitting a significant recession or even, depressionary levels at the end of this, in which case we're seriously deflationary. And then you want to be your best, your best bets could be fixed income, gold, very safe assets. And both outcomes are, I can't even nobody can even put a probability on, is it 50-50, 10, 90, whatever. But the important thing to say is the variability of outcomes has changed dramatically. And that's uncertainty that Brendan was speaking about. These big outcomes and they're massively different in different directions. We are going to hit them. I mean, the chances of conflict are higher. And look, all of these things we'll get through and we'll be better off at the end of it. The only thing that's really bad is as long as the US doesn't get into conflict with China. That's the only, that's the only outcome we don't want. We're reaching these things where they're reaching the end of the debt cycle in the US. Without going into details of it, something's going to have to blow up. It's either going to be inflation or there's going to be, incredible financial repression, which is also going to, which is going to be, also going to make things very difficult. But all of those things sort themselves out. So that's the thing I would say is there is a path through it. I don't know. I feel things are unlikely that the governments will take the political choices to stop what's going to happen. I mean, we saw that now with this latest budget where we realized that Trump wasn't going to be cutting the spending or is incapable of it because all these things like Dodge was a distraction. It's not doing anything. Even the tariffs, and they talk about how much you need in terms of revenue. What's it going to bring in? If you end up with an average tariff of about 15%, that's $100 billion. That doesn't touch anything. You have to cut Medicaid. You have to cut Social Security in the US. Those things aren't being cut. So we're still in that situation where the deficit's expanding. So we're still going to hit the problem. It's not going away. And in a couple of years we'll have another major crisis on our hands. Once again, from an investment point of view, the crisis can go in two different directions. So it's not like inflation and then you lose the value of that. Or
you're just breaking up a little bit there, Carl.
Sorry.
There you go.
Can you hear me
Coming
now?
through again now. Yeah. I think it's a bit dodgy. I think it's just true.
Okay.
Can you hear us?
Yes, I can hear you fine. Hope you can hear
Cool.
me. So really, that's what I want to say is now's the time to really be paying attention and not be sitting on the sidelines because, you can get run over by things going in a different direction if you're not, if you're not, I wouldn't say paying attention, but if you're not involved. I mean, so even though these things might move slowly and they're a few years away, I mean, I don't know if you ever remember a movie called A Fish Called Wonder, where there was that guy standing in front of this what do you call those things that roll slowly? Not a bulldoze.
It's
Yeah,
a while. Yeah.
yeah. Anyway, you know,
The steamroller.
yeah, a
Have you got
steamroller, and he's
All
like
right.
walking in front of it, it's going slowly, and eventually he just doesn't pay attention and he gets flattened by it. Or pushed into the concrete. That's essentially what's happening. It's coming, but nobody's governments aren't taking the required actions. Trump's doing some of that, but not on the fiscal side. So we're still going to see that fiscal steamroller hit all of us in a couple of years. So that's not going away. So we got to get ready for that. And as I said, the directions can go multiple in many ways.
Yeah.
Certainly makes an exciting time to be in investments because, it's that old thing that Lennon said. Sometimes you have years where nothing happens, and sometimes you have weeks where years happen, and we're in that situation where every week it seems like something major's changing.
Yeah, you call it exciting, but for the average person that make them feel a little bit uneasy. But I hear you. Though. It's just a question on that is, or maybe more of a statement is, regardless of who came in, whether it was the Republicans or the Democrats, or it was Trump or Kamala, they all were going to be faced with this twin deficit issue. Like it was going to have to be faced.
Exactly.
It's in your opinion, do you think Trump taking over, like although his actions have been like you mentioned now, he's been trying but not really, and Doge was more of a sentiment kind of push and more of a distraction, like you said. Do you think a Trump administration would have been further or is further along than a Kamala would have been?
I think he's further along in terms of they're talking about dealing with it. Now, there's a lot of criticism on how they're dealing with it. Things that I personally don't like, and I think a lot of people haven't enjoyed. But he has been dealing with it, but not with the biggest problem, of course, which is the deficits. He is dealing very much with a case of the US is withdrawing from the rest of the world. And like I said, I think a lot of this, if the Democrats had come in power, a lot of this would have happened anyway, just because the US can't afford NATO. NATO is not necessary for the US anymore. It really isn't. It's the same type of thing. Like I said, when Vance broke up with Europe, he did it in a horrible way, saying it's not me, it's you. The Democrats would have done it in a nicer way, but it was going to happen anyway. These things are, geopolitical constraints that, and when you look at how geopolitics works, it's very often, countries operate against the constraints, economic and geopolitical, that they end up facing. And the Democrats would have faced those same ones. They would have dealt with it maybe slightly differently, and probably been a little bit more under the steamroller because Trump's dealing with it more. But so what you're ending up with is the break with China is inevitable, and I mean, or they have to break. They can't so much because pretty much everything's made in China. We're not just talking cheap toys anymore. Those days are done. China has the most advanced manufacturing in the world. More than 50% of anything you made is made in China at this point. And because of their next door supply chains and that, they can just make it cheaper than everybody else by quite a significant margin. So that's not going to, that's not going to change. I mean, Apple on their own invested nearly $700 billion just in training in China and plant equipment. You add in other companies like that, the sums are trillions. You can't replace that, not easily. I mean, yes, you might have AI and robotics being able to change some things going forward, but the US is not going to become this massive manufacturing plant. What they are going to do is just try to get some of the stuff away from China. I don't know if it's a positive or negative for South Africa, because we're going to get lots of cheap Chinese manufactured goods brought here at a huge we're getting before at a lower price. Stuff gets dumped here because basically our manufacturing time.
Carl, you there? You're coming in and out a little bit.
Okay. Yeah, I can see it swaps between Wi-Fi, landline all the time on the internet here. Okay. Sorry, now. But I was saying, so from that, I think we might benefit as consumers. Market, the Europeans are going to have to do it too. They're going to have to start shutting them.
All right, Carl, you're breaking up a little bit. Maybe sort out the Wi-Fi thing, and then we can come back to you. But it's actually an interesting question I'd like to open up to the rest of the panel. Is obviously Carl speaking specifically about Trump or the US and the China relations, but specifically South Africa and the meeting we had last week, where Ramaphosa was meeting with Trump in the Oval Office. They were obviously there to discuss trade, and that really wasn't the intention from Trump, I believe, in that meeting. But do we think that BRICS could somewhat offset, or if we improve our relationship with the BRICS countries, could that somewhat offset AGOA and its current impact? And I don't know, maybe just a feel from the panel as well. Do we think AGOA is gonna be renewed?
Cameron, I'll have a go at that. I think you can assume that AGOA in its current form is dead. I think Trump likes bilateral negotiations, but it will be replaced by more bilateral trade relationships. I think that it's a fool's errand to think that we're suddenly going to replace the US with BRICS. Remember, the US is a net importer, and the other countries, China, India, etc., China in particular, are net exporters. And so therefore, to assume that we can trade, replace our export markets is going to be quite, I think, is a bit of a fool's errand. Yeah, so I think that the assumption, especially among some parts of government and in Labour, we'll just replace one of the others, not going to happen.
Yeah. It's not going to be a like-for-like trade-off. I think what South Africa needs to do, it's probably not just necessarily increase who we trade with, but also like increase our competitiveness. I mean, we're struggling so much at the moment with port inefficiency, with the labor laws that we've got here, and as well as, I mean, the high cost of business for internationals to come and do work here. I think we need to improve that before we find ourselves in a position where we can start being more competitive.
I think the meeting with Trump, I mean, while this has probably been analyzed ad nauseum in the media and other places, as you might, whatever the motivations Trump had and whatever his objectives were, I think that the meeting with Trump was important because it did shine the spotlight on the structural issues, whether it's crime, whether it's a tax on arrivals. I mean, the members of this panel, as well as the guests, I've often heard Franz Cronje come and talk about the fact that there's an ICT space, a 30% tax on arrival. Imagine you're saying to the rest of the world, come and invest in our country. But if every $100 you put in, you've got to get $30 away. Okay. And the maths, by the way, for those that haven't figured that out, the maths is quite simple. If a foreign investor wants to make a 20% return on the investment, they would put $100 into another country, and they need to make $20 off that. When they arrive in South Africa, they have to put $100 in, but they're really only putting $70 in, and then they've got to make $20 off $70. Okay. Now that suddenly means that the return hurdles to making South Africa attractive as an investment destination are so much dramatically higher, okay, compared to other countries. And so, so again, not going into the substance of the meeting, the ambush, the matters that were raised, I think it does draw, it does bring to both the GNU and to South Africa the stark matters and challenges that we face. Crime as well. This is not genocide. It's just you got to deal with rural safety, you got to deal with urban safety. And without passing judgment, for example, on the BE law regulations around ownership or employment equity, etc., like that. If the vast majority of the country or the leaders of the country say, guys, we are going to have ownership requirements or we're going to have employment equity, so be it, because that is what the country's decided. What you need to understand is the consequences of that. And I think right now the narrative, which I think Trump is forcing, is that the narrative is, oh, you're anti-transformation or for transformation or not. That's missing the point. Is if there's a policy, this is a policy, but this is the consequence of the policy. And if the policy is anti-growth or anti-investment, that's the consequence. You can put all sorts of employment equity rules in place. It's great. If that's what the national priority of the country is, then you need to do that. But what you are missing the point is that this does make us very investor unfriendly. And if we're going to get our GDFI fixed investment from 15% where it currently sits, and that generates only 1% economic growth, the maths is simple. If we want to get 5% economic growth, we need to have 25% fixed investment into this economy. We need 10%. That 10% ain't coming locally. Okay, you're only going to fill that up for foreign investors. And this is where the rub of it is. If we want to get to 5% growth and create 500,000 jobs a year, we need that 10%. Turning to BRICS, they're not coming here. BRICS is not, China's not going to put that 10% in. China might build a project, but they'll put their laborers in, and then they'll leave. The pots of capital that you need to seek are in the West, they are in the US, in Europe, and that's where you want to, those are the pots of money that are willing to invest and to come, and you need to target that money. And I think that came very evident. I watched the ambush meeting twice, but I think more telling was the president gave a speech afterwards. For an hour, he took questions from journalists. And if you Google it or go to YouTube, you can find the interview. And I'll even tell you now, if you go to minute 35 in that speech, because I actually took excerpts out of that speech, he spoke about now, unfortunately, what he says and what the ANC does will be a different matter, or what the GNU does. But at minute 35, starts around minute 34, 35, he says at the end of the day, economic growth and foreign investment is our biggest single priority. And if we need to amend or change our internal domestic policies and laws to bring that investment in, we need to do that. Now, that's very telling. Whether government will follow through, I don't know. But certainly at a policy level, at the senior levels within government and the GNU, I think there's this realization. We just need to see whether it does flow through. So yeah, so again, I think that Trump, for all his bombasticity, brought, he forces us to confront our decision making and the consequences of our decision making.
Yeah, yeah.
There's
That's very
also
true.
there are also many competing jurisdictions for that pots of foreign capital. So we're not the only show in town. There are a lot of other shows which are fairly attractive. I mean, Namibia right now is fairly attractive for foreigners. I was speaking with Carl. I think I was speaking with you, where the economy over the next sort of decades probably set to not increase by a percentage, but multiply, in terms of GDP. And I was speaking with a friend of mine who owns Document Warehouse, and they've got branches there. And he said that Namibia is already going crazy. Property prices have already exploded, and they're set to go higher because they haven't started taking oil out of the sea yet. So we're not the only show in town. We have to get cracking with attracting this capital now.
Mm-hmm.
Yeah, I hear you. I think sorry. Yeah, no, it's very true. Just everything that's happening at the moment, like we have to look internally to fix it. I was listening to a BizNews interview the other day. One of the heads of AfriForum was speaking about how I wasn't allowed, but during apartheid, the only time that there was significant change in in our government was when international people got involved. And so it's sad that it gets to the point where we need international involvement for us to start fixing our own kind of governmental structure. So yeah, no, I hear that there's a lot to be done there. We do have a question from Beaker who asked, what is your take? And I know Jeff, you kind of touched on there, but on the triple BEE policy regarding international investors. Is that something that's going to?
Well, I think I have touched on. Look, so I think that listen, if we want to build this economy and build a future for all our children, you need economic transformation in South Africa. Okay, you need all people to participate in the wealth of the economy, and there's two routes that you can go. The one is you can have redistributive policies, which we currently have, and when you're fighting over the same, you're all fighting over the same pieces of the pie, or the same pie. It becomes very destructive, and you get policies that have inadvertent consequences, like scaring off potentially foreign investment. If you're growing the pie, obviously, if in the last 10 years, just think about this, if in the last 10 years we had grown the economy at 5% per annum, okay, this economy would be 70% bigger. Imagine the tax revenue that could be collected from that to put into social spending. At 70% bigger, even if you assume that every white business in South Africa is racist. There are not enough white people to do the jobs. So if you're going to drive inclusion, if you grow this place, there's going to be natural absorption of the labor and much more flexibility in the labor market. So I think the imperative is for redistribution, or that's I shouldn't say. I think the imperative is for bringing a more and building a more inclusive economy. We have to do that. That is, and we have to solve land issues, etc. These are not debatable and have to be done. I think the issue is potentially how they are achieved and the objectives that will achieve them. So the point being is, at the end of the day, we've got policies. There are consequences of policy. And we need to understand as a nation, when you choose certain policies, what is the outcome of that policy. And I really, crystal ball, where does this go? How does policy in South Africa shift? But I do think that your observation is correct that generally unless there's a Damascus moment in South Africa, like most countries, external stress or pressure can sometimes force us to face the consequence of the decisions. So I'm talking, Brandon, I hand over to you.
Brandon, go for it.
Yes, I think, just first of all, to echo what Jeff has said, a more inclusive, diverse workforce does only serve a social good, but actually ultimately unlocks an enormous amount of economic potential in South Africa. But we've also got to be very, very careful that as soon as you regulate, as soon as you incorporate any bit of legislation rule, you do it because there's a benefit, but there's also invariably a cost. It's very, very seldom that you have regulation that doesn't have a cost and a benefit. And I think we've got to be very careful in South Africa in terms of how that is balanced, because you do get that sort of risk of like unfettered populism, where actually the consideration for the hard outcomes, or let me put it differently, whether we sort of have a realistic probability of achieving the outcome for which you put regulation in the first place. And what's quite interesting about the foreign investment side and local stake is that clearly a one-size-fits-all is pretty nonsensical. As soon as you've got something that's nonsensical, it needs to be looked at quite carefully. So, for example, if you have foreign mining companies who are going to come out and exploit South African natural resources and whatever, it's pretty much a no-brainer that you can get that local participation. And not only is it good for South Africa and South Africans, from the perspective of the international investor, there is no opportunity cost to that, right? You need a supply that, or if there is very, very small. But I suppose the whole Starlink thing starts casting a bit of a light. Now, let's leave Elon Musk out of this completely. Let's leave the personalities out of it. But you could say the same for manufacturers of very, very advanced microchips or what have you. When you start looking for local investors in that, the only place you really got is distribution, et cetera, et cetera. But what's very, very apparent is that one-size-fits-all policies clearly don't take into account the exigencies of the actual investment being made. So sometimes it's quite useful to look at an edge case or an extreme case where it's just patently absurd. So I think that the one challenge we obviously have is just the labels we give things. If we're talking about Black economic empowerment, we're talking about employment equity, etc., from a values and normative point of view, it sounds like an unequivocal good. But whether that links one-to-one in lockstep with the transformation that we need in our underlying economy and our workforces is a place for healthy debate. So I think that the one positive that emerges from this is that it's very, very politically difficult inside the ANC to address some of these policies. It's politically fraught. So you can have the DA with a very, very strong view on empowerment and what have you, and the pitfalls, but actually the internal debate in the ANC is a difficult one. So I think just some of these pressures out there, and Jeff alluded to it, when you've got the president sort of saying foreign investment is our number one. Now, I'm not sure if it is the number one, by the way. I think one can say it. I'm not sure if it is the number one priority. But if it's high on the priority list, then due consideration needs to be given to this. And I think that mostly what we need in this country is we need to have a very much more clear idea of the what we intend to produce as a result in terms of transformation of our economy, and whether what we're doing actually is an enabler for that, or whether it is fraught. And I think what we also need to be is a little bit more open to reviewing whether things work. Because in the beginning, when you put a policy in place, you have an expectation as to what's going to happen, and then you have a passage of time. And in that time, you get various points where you get the opportunity to evaluate it. It's not clear to me that we have evaluated with as much rigor as we've legislated. And possibly that would be like just a bit more of a positive development.
Yeah, completely agree. Carl, I see your hand is raised. I think we just need to move on from this topic, just in the interest of time. We still can still touch back on it again. But I think we framed this panel as specifically to advisors, and I think Alex, you're probably in the best position out of all of us here, leading an advice firm as well, to kind of highlight, with everything that's going on, what risks would a client or a advisor particularly be facing at the moment that they might not completely be aware of yet?
Yeah, they might or might not be aware of it. So over the past 25, 26 years, I've seen portfolios blow up for a whole lot of reasons, and lives fall apart for a whole host of reasons as well. And I'd say the biggest one is usually because there is no plan. So individuals often have no plan, and because they have no plan, they don't know where they're going. So we've started doing something quite interesting. We've started encouraging people to write their eulogies. So write your own eulogy, and we've mapped out a process for how you write a eulogy, because it's quite a traumatic experience. And then from there, kind of work backwards to present day terms, and then the path towards that end state becomes more clear. And you tend to be going in the right direction more often than not. But we've extended this into the business as well, into the group, and what we found is that we weren't hitting our quarterly objectives as often as we wanted to. So we might want to get a new system in place, and it wasn't happening on time, and it was because the planning was poor. So I think the same is true with individuals. Get a plan going, and we obviously use WealthBit to do planning, but it's a good place to start by actually writing a eulogy. That's the ultimate plan for lives. So I'd say that's the first thing. The second thing would be, once you've got that plan, you probably know what sort of return expectation you need to achieve from the portfolio to get to that outcome you're after. And to get to that return expectation, you need the right asset allocation. So what level of bonds, property, cash, local and abroad, should you have in your portfolio to get a predictable return? And then the third big one, and often we see individuals get that wrong as well, where their portfolio itself might be ideal, but then they happen to have 3 or 4 investment properties, and those 3 or 4 investment properties actually make up the bulk of their asset base. And what it means is that their asset allocation, although within their portfolio, is perfect, because they're so heavily overweight property, it's a problem. Or they have a lot of money in the bank account, so they're heavily overweight cash. So their overall situation doesn't get them towards a return outcome that they need. But then the third big risk, and it speaks to the second risk in the property example as well, is that they have a concentration risk. There's a concentration risk within portfolios. So to take that property example, if you invest into a single residential property, you're exposing yourself to, and that's your only asset, you're exposing yourself to one asset class, which is property, one jurisdiction, which is South Africa, and then one single investment, which is that one property. So if that one property doesn't go well, and tenants often don't pay, then it's a disaster. And we take that same approach with investments as well, where you never want to give all your money to one fund manager. That one fund manager, they're all bright people. They're all really, really bright people. But every now and again, they get it wrong. And when they get it wrong, you don't want it to affect your life. The second concentration risk we often see is most investors are so heavily invested in this one land mass on the southern tip of Africa. And if South Africa doesn't work out for whatever reason, it could blow up portfolios. So avoid concentration risks at all costs.
Yeah, no, I completely agree. I think you touched on an important subject there, which is about the coaching and kind of having a holistic view. It's not we can play our part in terms of making sure that the investment funds perform, but it goes beyond that. It involves the financial advisors to be educating their clients, and clients themselves needing to be educated as well. But Becky, I know we've also had discussions previously, specifically about the role that financial coaching plays with regards to, if we follow along the same narrative we've had, which is to achieve financial freedom. Coaching is probably quite important. I know you share that same view. If you'd like to expand on that.
No, sure. No, thanks, Kim. So I think just listen to everybody. I mean, it's quite clear that the investment world is becoming more complex, more volatile, and probably more unpredictable than we've witnessed in probably the last 2 decades or so. So I think in a sense, then what is the one thing that maybe we can add to the factors that affect client outcomes that is much more sort of more predictable? And I think financial coaching is probably one of those things. So I think in a sense, like, client outcomes, for them to be consistent and positive, it's a lot more than just sort of like investment alpha. Investment alpha is very important, but I think if you're running a business, also the way you run your own business as well is quite important. So there's almost like a practice, like a business management or practice management alpha there as well. And then the financial coaching. So in a sense, I think one way of thinking about these things is, what are the different levers that one can pull to be able to impact client outcomes. So I think financial coaching in that sense is quite helpful. And I think if you look in a number of markets, if you look in the UK, for example, there's also this sort of element of specialization as well, where you sort of outsource the multi management, sort of the asset management to an asset consultant or to a multi manager, and then sort of free up time for the financial advisor to spend more time engaging with clients, doing better financial coaching. Because we all know that, for example, I mean, just to throw an additional curveball. So when we think about markets, all of these returns we're talking about are time weighted returns, which is correct, right? Because you're trying to measure the performance of the underlying asset managers or the multi manager. You measure that in time weighted returns. But what the clients actually experience is something different that we call a money weighted return. And that's something different altogether. And what are the things that affect money weighted returns? I think financial coaching really comes into play, because the client behavior, when they take money out, when they put money in, I think Alex made a very interesting point earlier on about sort of clients sitting on the sidelines waiting for the perfect time to get into the market, right? So portfolios can actually do very well whilst the client does very poorly. So that's just to add another additional dynamic in there. So I think from that perspective, I think the last sort of 10 years in the industry, I think this whole concept of financial coaching has really come into play, to say, as financial advisors, there's a coaching way of advising your clients, because I think ultimately financial advisors have got a big role to play. That even if the portfolios do well, but the financial advisor doesn't do well in terms of managing the client, then all of these things kind of fall flat. So a lot of things that I'm throwing in there.
Yes.
Just to make the point that there's a lot of complexity in our industry, in the markets, but also in our industry as well. I think another interesting element, I think the point you're talking, Alex, about running a practice. I think most of us, there was a lot of buzz about robo advisors going to replace that financial advisors, etc. But I think it's quite clear that that's not going to happen, right? But I think what's probably going to happen is that the advisor that harnesses technology smartly is probably going to eat your lunch. So that's another dynamic as well for financial advisors, just to think about all of these buckets in the asset consulting, the financial coaching, in the practice management. And you kind of need to get all of those things right to be able to get the predictable client outcomes and also the profitability for yourself as well as a financial advisor. So yeah, I know it's a little bit of a fruit salad in there, but
no, but it's
hopefully
true
there's
though. It's
something
so
to
true.
chew on there.
It's like
Yeah.
you got to. It's also that you've got so many responsibilities as an advisor that you kind of need to choose your battles, and that's why I think robo advisors, although probably scalable, probably you lose that human touch, which is really what I think makes a difference for what a good financial advisor is. I know we're very short on time now, so I'd like to just you touched on it as well, Becky. It's like where to invest and how to invest and all of that. I know it's a hot topic is currently, and you also mentioned with tech as well. The tech center of the world has largely been the US, and we see now that the tech mega caps are kind of run. Adam, my question to you then is US the place to be? But even if it's not the place to be, where would you potentially be moving your portfolios?
Thanks, Cameron. I think just to bring everything together for everyone, and kind of end this theme of looking after clients, and the uncertainty that's currently being faced, the changes in the world, possibly epic changing, epochs changing and regimes changing, coaching clients, all of this stuff I think comes down to the point really that one has to have a diversified program. And I know it sounds trite. I know that, you kind of fall back always to this thing about having diversification between domestic and global, between different asset classes. But with all this uncertainty that everyone's been talking about, with having to, with the most important message in terms of advice and coaching being to have a program and to stick to that program, I think, it's going to be the same answer globally. You know, whether the US is now in an ultimate decline and one has to invest in only in China, or where the one thinks the dollar is going to decline and one only has to invest in gold. These are extremes, and really one doesn't know. And at the end of the day, I mean, my answer to you, Cameron, and to anybody, any investor is one has to have a properly diversified domestic and global portfolio, and that means investing in different asset classes and in different regions, in a carefully constructed portfolio with uncorrelated assets, be those fixed income. I think fixed income at the moment globally is starting to offer some value. US yields have moved up, and I think that the disinflationary trends are actually stronger than many anticipate, meaning that I think global bond yields offer value in terms of diversification, and correlation versus global equities. I wouldn't be quick, at least in the short term, to completely count the US out. So Cam, I think the answer for me is to have a broadly diversified portfolio, which is going to be able to benefit from emerging market growth, of which South Africa is a component, global growth, and defensive assets. Unfortunately, not a very satisfactory answer. I know people want, buy this, buy that, but in the real world, it doesn't work like that. One has to have a diversified portfolio and stick with one's program. So,
I hear
yeah,
you.
bringing everything together, this uncertainty, helping your clients by keeping with the program. Unfortunately or fortunately, that old truth is there. Diversify and stick with your program, and I think Cinnabar's on that track, on that path.
Yeah. Yeah, I was gonna say if we could just take it into a key takeaway, but I think you've done that right there. I just want to let everyone know. So we have clocked over 9 o'clock now. But the good news, I've chatted to the panelists, and so if you do need to go, we appreciate you for joining. We will be staying on a couple. I know Adam has to go, I think, and a few others, but we still gonna open up the platform. So if anyone wants to keep asking questions, we've got a couple more we're gonna answer. We're gonna run over. But if you need to go now, then yeah, thank you again for joining.
Thanks for the opportunity, and if there's any questions that I need to address later, please let me know. Thanks, everyone.
Yeah, of course. Thanks, Adam. Yeah, so you can just send us if you want, obviously post questions here, but if it's after the session, you think of something, your client asks you something, or you as the end client need some clarity, please reach out to any of us and we can help you on that. All right, a couple of the questions that have come through, and so, like I said, this will be to the broader group. Here we go. The influence of big businesses. How can they convince governments that the free market is the only way to get jobs and build small business concerns?
That's a
Okay,
million
well,
dollar question.
Yeah.
Um,
Well, that's what we had to answer.
I think, look,
One thing.
I think if I might just add, I think South African business for a long time has, and I suspect continues to be incredibly wary of engaging government or pushing an agenda with government. And so therefore, it would be good if business could change, but remember that you have a government that has historically, ideologically opposed or seen business as the opposition. And so therefore has feared to engage or carry an agenda, as it were. And I'm not sure if that is going to be easily changeable. The government makes lots of noise around, they've even got a Minister of Small Business Development. I mean, I'd love to see how many businesses the government has created, okay, through their Bureau of Small Business Development. I saw a stat the other day. In Denmark, it takes 15 minutes to open a small business. In South Africa, it takes 16 hours to open a small business of work. Okay. So there's your start. Anyway, so I don't hold a very strong view there. It has to be driven out of government.
Brandon?
Change ideology.
Yeah, if I can just add one thing, I want to be a little bit controversial, is that question actually involved a statement and then a question. So the question is, how does big business convince? But the other one is the free economy that works. And I think just let's temper it. I mean, what we know for sure, centrally planned economies haven't worked. I mean, the failure of the Soviet Union and many other countries at the extremes, North Korea, kind of give us an edge case. But we've got actually a lot in between. And what's quite interesting is the US, obviously powerhouse of the global economy. It's been the big growth story. On a lot of like OECD sort of stats, does very poorly. If you look at the state of their healthcare, longevity, all the wellness indices, and you compare that to Europe, which is apparently a basket case if you listen to old JD Vance and the rest. But the World Economic Forum put together a competitiveness survey, which I'm sure they still do. I just haven't read it for a couple of years. But in the top 10 most competitive countries in the world, you had all the Nordic states, and Jeff's mentioned one of them. So you've got Sweden, Norway, Finland, you've got Iceland, you've got Denmark. And these are actually mixed economies, right? So they're definitely driven by free market forces, but there's actually a fair amount of government intervention in those things. The other one, of course, which is kind of, was the darling of the world and then fettered out with the Southeast Asian economies that actually took off on the back of a lot of government intervention in fledgling industries. And obviously that didn't keep on going. There are a lot of negative consequences to ongoing government intervention. So I think to a certain degree, one has to look at the wisdom of those interventions, the appropriateness of those interventions, and more than anything, and that came from a question right now, the effective implementation of those interventions. So I think that in SA, we've got a lot of well-meaning policy, but a lot of question marks as to whether it has been effective, well, either effectively managed, or whether the capital investments have been frittered away, obviously, which is a major thing. But clearly in South Africa, we still have an economy that is dominated by prices that are largely made in the free market. So I think the interesting question, and Jeff said it, is I think business has always been a little bit timid in terms of taking on policy. Some firms are becoming more outspoken than they have been historically. But I sort of sense that some of our president's more successful interventions in the last year or two, and we know there's a little special unit there that is getting some traction, I think will probably invite a more open dialogue. And I think as that dialogue opens up, we might see slightly more concerted pressure coming from it. I'm not saying that's a crystal ball prediction, But I think that dialogue is going to start opening up a little bit more than it has been. And that pressure may gently start, or even more than gently start increasing. That's opinion, it's not crystal gazing.
Dick, I see your hands are so raised. You want to just add to that?
Yes, yeah, I think I quite agree with the last speaker's point around, I think ideology doesn't really work very well, and probably, sort of just moving to sort of common sense, policies is going to be sort of key for inclusive growth. I mean, if you look at South Africa at the moment, I think, pre-COVID, we probably had maybe 15 million people employed formally. I mean, 2/3 of those people were already employed with small businesses. So even if you look at the government's own National Development Plan 2030, 80 to 90% of new jobs would have to come from small businesses. So I mean, I'll give you an example of a policy that I think government actually came up with that was actually doing quite well, and for some reason they haven't extended it. So if you look at 12J, which was actually quite a innovative structure to help small businesses to access funding. So I think in the 10 years or so that 12J was operating from 2009 to about 2021, it raised about 13 billion rands that was invested in small businesses. So now they've converted it now to 12B, and I think 12B is actually working quite well as well. So I think that idea that you come up with a policy and there's a clear goal and you're able to measure the impact of it. So 12J, for example, the research that was done, that it was creating jobs at 10 times less the cost that a lot of government programs are actually, are creating jobs. So I think it was 30,000 compared to about 400 something thousand that some of these government programs are actually creating jobs at. So I think government policy, when done thoughtfully, can be quite helpful. But I think a lot of things are ideologically based, and as a result, they're not helping a lot. And I mean, unemployment in South Africa, youth unemployment in South Africa is running over 50%, right? There's more than 10 million. Now there's even graduate unemployment. I mean, I mean, we run a small program ourselves of employing young graduates, and the level of unemployment of graduates in South Africa is absolutely staggering. So I think a lot of policies just need to go back to sort of like common sense to say, what exactly are we trying to achieve? And I agree with Brendan. I mean, I spent a lot of time in the Nordics, and the Nordic countries, I think, they probably got one of the most interesting models because they've kind of harnessed the power of free markets, almost like what the US does. And then they do something that some people might even call socialist, right? But then they get the balance right. The healthcare makes a lot of sense. The infrastructure, the public services, policing, safety. So I think a lot of things you just need to go back to common sense. Like, what are you trying to achieve? And measure it and evaluate it, thoughtfully, and sort of get away from sort of ideological, sort of thinking, because I think that's where like everything just sort of falls apart, when it's looked in that way.
Perfect. Paul, you also to add to this.
Yeah.
I've got there's two questions that have come back to back now, and both involve a different topic. So yeah.
All right. Well, I just wanted to give an idea of how ideology is so important in terms of if South Africa wanted to bring in fixed investment, what you would require. Like I made that point about Apple in China specifically. Now, to keep in mind, before Apple was in China, it was originally in Ireland and Korea. They were building the iPhones. They had all the factories there. And the way China was able to almost take that manufacturing away from those other areas is they ended up operating at extremely low margins. Literally Foxconn was running at 1 to 2% profit margins. But why they could get what they got in instead was Apple would send engineers and all of their logistics managers and pretty much all the brainpower from Apple were being sent to train all the guys at Foxconn. So what would happen is, so much so that United Airlines dedicated 2 flights a week just for Apple engineers to fly to China. Think about that. So you actually had this top talent from the US in terms of engineering, brand design, coding, literally flying all the time. They would train, hundreds and hundreds of engineers in China, or not even engineers, people in all different parts of the production. And what Foxconn did, as soon as those guys were trained, they would send them off somewhere else and place new people in there. So in order for Apple to keep their production going up, they had to keep retraining the people. All those people were then trained, and then they'd also move everywhere else. So Huawei's phones and Xiaomi's phones were completely designed off guys trained by the best minds in the US from Apple. They did the same with Tesla, which is why Xiaomi now has phones and electric cars that are better than what they get in the US, because they literally got their training. But what they did, it was, from the outside, it really looked like it was exploitation. You were coming in there, the workers were working these long hours, low pay, companies weren't making any margins, but they did it in order to get that. And they really were able to take that manufacturing away from other countries that needed to make profit. Now, you can look at the pros and cons on that, but that's almost the complete opposite extreme from where South Africa exists now. Where for us, we want to get a whole lot of money coming in, we tax it up front, that type of thing. And as you said, there are other places in the world that are, we're not the only show in town. So
we're competing. We need to be competitive, 100%. Yeah.
Now, I don't know if we want to go to the extreme that we end up all of that, especially because, from an ideological space, it can be seen as exploitative.
Yeah.
But I mean, it worked, very much to China's benefit in creating their own national champions now.
Yeah, no, it's something we definitely need to be doing. And I know, Jeff, you need to go. And so before you leave, what's your one key takeaway that you think everyone should, if they're going to have one thing that they take away from this session, what would that be? Yeah, one sentence.
Very boring and say diversify portfolio, have exposure to lots of asset classes, lots of markets, lots of sectors, industries, themes. But I actually think that I think things are looking much better for South Africa, both economically, I think socially, let's say politically, and our market's attractive. I think there's disruptions around the world, but by and by, I'm quite optimistic for outcomes over the next year or two, notwithstanding the massive uncertainty that Brandon spoke about earlier on. So don't lose sight of the opportunities that uncertainties can create.
Yeah. Okay.
Thanks.
All right. Thank you, Jeff. Appreciate you for joining. All right.
Okay.
For our remaining panelists, there's two questions. They are, what are your views on the rise of AI? Obviously, that's taken over quite a bit, and its utility. But specifically, how's it going to change the economics and then also investing as a result? Don't know if anyone wants to have a stab at that.
Can I tell a story here, Cam?
You're more than welcome to.
So I heard a story from our head of product in WealthBit the other day, and no, it wasn't him. It was actually from a person who was in Silicon Valley, and he's now involved with satellites and whatnot. And he said that someone programmed a bot to, first of all, search for all the secondhand watch dealers in New York, and there were about 200. He then trained this bot to put on a Texan accent and research who had a certain watch, right? And he found 3 dealers had this certain high-end, very expensive watch. This Texan bot then played these 3 dealers off against each other until he got this watch for the lowest price he could. He then approached the other 197 watch dealers and put on a different accent, a British accent, and sold this watch and made $5,000 profit. And this all happened within the space of 7 hours. So I think that gives us a cue as to what's likely to come our way. And to Becky's point, I think if you aren't using technology, you're going to be squashed by it. And so I think that in the advice world, that's certainly going to happen. I think it also has enormous ramifications for the investing world, where so much is possible with smaller teams. So that would be my takeaway.
Yeah, no, I completely agree. You can use it just improve productivity. Is obviously everyone has this big sense that it's going to replace jobs, but it's more about what it allows everyone in the current role to do going forward. Brandon, your hand is also raised. You want to add more to this?
Yeah, just three quick things, like very, very quick. So one is we've seen various points of inflection historically and more recently just in computing power and what it can do. But the point of inflection here in terms of global productivity can be absolutely off the charts. I don't think we've actually seen anything. I mean, I was just thinking about the little teams of young MBAs working for McKinsey and Monitor back in the day, and scurrying around producing reports based on vast amount of information. You can do that like literally, and I'm not talking about minutes, but in a day's work, you can produce the same product. So firstly, I don't think it's going to dumb down the world. It's very, very clear that in many respects, AI could actually exacerbate inequality, because the degree to which one is able to harness it and use it really, really is a function of training, how articulate you are. So what you give is what you get. So I'm giving you a very sort of optimistic view that is tempered by the fact that it is not like, it's not a great equalizer. I think the long-term view we need to be very, very, very nervous about is literally humanity. And I'm not a doomsday here at all, but it's going to be very hard to keep this technology under control. It's impossible to keep it in the right hands, out the right hands, impossible to keep it benign. And I mean, it's often been sort of discussed, but it is fundamentally true. Human beings have evolved over millions of years by being the smartest creature on the planet. At some point in the not too distant future, that is not going to be true.
Might
But
already
how they
be not
guide
true.
us right now is actually not really the most important thing. That's for policymakers, that's Silicon Valley, and for governments. As users of that technology in business, if you are not engaging and actively investing in what it can do for your business, all right, you could miss possibly the biggest trick in your career. And there'll be people in this room, like me and longer than me, have been in this industry for decades and decades and decades. And there's never been a point in time where it's more important to get on top of something quickly. And by quickly, I mean wait 6 months, and that is too long. That's too long.
Yeah, I agree with you. I think it's the interesting part is how it affects investments, and you obviously have strategies built off of AI, and I think, like you said, it's going to help with the data processing, but it's always going to come down to applying sentiment and a little bit of, it was mentioned earlier, but common sense, I think is
Yeah.
is
So
going to be so
very
important.
quickly, be cautious. I've heard a lot of people talking extensively they're using AI in their research process, and you've got to be very, very clear on how you think and understand it, where you can trust it or not, because it does feed absolute nonsense back to you. I mean, I finished a master's degree a couple of years just at the beginning of where AI was coming in, and the extent to which it will lie to you about facts. Don't look for, if you are looking for facts on ChatGPT, find a second way of verifying them. So AI is incredibly powerful at what it does well, but I see a lot of investment professionals saying that this is the holy grail, found Mecca here, because ChatGPT is doing all the work for me. So crunching a lot of data, yes, but not all ChatGPT, by the way. But be careful, because you can go and ask for 10 references on something and they are all 100% made up. And credible, very, very credible, but completely made up.
Yeah, no, I hear you. I mean, trying to use it by myself, it is. You'll tell it to use you'll give the web reference, put it in there, and ask it to write a summary on it, and it completely just hallucinates almost entirely, and to the point where it even changes the original reference website that I put in. So
or it doesn't exist.
Yeah, it's got you got to kind of be careful for that. There's another question here. What are we seeing from upcoming investor behavior? And so I'll add a little bit more to that because they provided some context here. But there's been a trend of moving towards the lower cost instruments like ETFs and index funds, more than working with the professionals. So less allocating to active managers. So one, how is this going to play out? What are the inherent risks in investing into ETFs and index funds? And then how does one go about addressing it? So as an investment professional yourselves. I mean, I'll go. Let me speak to this one actually. So there has been a trend, and I've seen it a lot on the social media space. There's been a trend from financial advisors or people that try to influence, that try to build an audience by saying what people want to hear, not necessarily what they need to hear. And so the roles of ETFs and index funds in portfolios, we utilize it, and we still believe that they have a place, but you have to be cautious of what you are buying into. So just to say you're buying into an index fund because it's the cheapest one, and it tracks the entire US stock market, might have been good over the past, but as we've discussed throughout the session, you've got to understand that what you're buying into now is, especially if you're buying into the US, you're buying into a super concentrated portfolio where it's really just your Mag 7, your tech heavy stocks that make up, I think the numbers, the top 5 stocks make, I think 37 or 38% of the total US stock market. And so what you're getting is almost a third of your returns are purely driven from these investment these stocks. And so you get that inherent concentration risk. And so they've run, but there's the smaller caps and your mid caps, they need to start catching up. And so we've already started to see that there's been a broadening out in terms of where the returns are coming from. It has been still largely driven by these mega caps, but the smaller companies are starting to perform well as well. And so it's important to caveat that it might be long-term cheaper, and being in ETF funds have probably outperformed over the past 8 years, 9 years. But at the same time, so has the US. And so just because it has happened, is not to say that it's going to be happening in the future. But we're always of the view that index funds and ETFs are a fantastic way. If the market's going to go up, like as a whole, ETFs are your best way to do it. It's only when it's going to be specific shoots within markets that active managers outperform over these periods. Carl, your hand's raised. I think we've got about 6 minutes left before
All right,
we.
I'll just give a quick just a couple of points on ETFs, which is interesting. Is the proliferation of ETFs, all types of strategies, have made it very easy to access investment strategies that used to be only the realm of, advanced hedge funds. So there's, if you have a type of strategy you want to implement in the investing world, you can pretty much find some 3-letter word that gives you access to it, which you can buy quite easily. The other thing to be quite aware of is, as soon as something becomes thematic, as I've noticed, when some narrative becomes popular and everybody's investing in it, and people launch a lot of ETFs, that's generally at the top of the market, and those things tend to underperform on that narrative. So it's 2 things. 1, it gives you great access, but 2, just as everything starts, just as they all become available, it's generally as that theme is playing out. So you need to treat them both with caution and not just be investing in it because that's what you heard what's been doing well lately. It creates exactly that same problem, but especially if people are doing it themselves, because they're listening to what they're getting on the internet and what people are talking about. It becomes an extreme version of killing your money weighted return, where every time you're investing in something that's just about a fall, you're buying into the top of it all the time. And you see that happening a lot, especially in the US, where you've got a large proliferation of ETFs and a lot of guys that are day trading onto those things. Anyway, okay, I'll keep that short.
No, I appreciate that. But you're making a point there, and I to touch on it slightly, and it's one of the follow-up questions. That a lot of people seem to be kind of guided by influencers on social media that people flock to for advice and guidance. And one cannot ignore the mediums investors are using for guidance, but also how does one compete with influencers with millions of followers who stick it to the man? I'm not sure if anyone has a view there. I think it's important that to acknowledge that the news source that the younger generation is now exposed to is less the mainstream media, and so you are getting a little bit more diversified content, but also access to these influencers that they might not necessarily have a background that kind of supports their claims. And so it's very important to obviously caveat the same thing as Brandon touched on about ChatGPT or AI. It can tell you one thing, but it's your responsibility to, before you make any investment decision, to make sure you corroborate it with some kind of research. Like don't just take their words for it, because they also, an influencer is never going to blow up by saying what everybody else is saying. They have to be inherently controversial, because that's the only way that they're going to get traction there. But I see all 3 hands are raised, so everyone's got to say here. So,
Brandon was up first.
I just want to pick up on that really, really good point about sort of ETFs getting launched on the back of themes and investable opportunities that are kind of trending. Some very interesting work done by Morningstar in the States on the sort of behavior gap. I can't remember what that report is called. But the behavior gap obviously being the difference between the return available, so what investments actually do, and the return experienced by investors based on their own behavior. And what you can see is this gap gets bigger and bigger and bigger the more specific the theme gets. So if you go and take like a US general equity fund, right, people are moving in and out of the asset class, but the behavior gap is small. As soon as you start getting into style and factors, and obviously at any given point something's running or it's lagging, the gap gets bigger. And then when you start getting into thematics like energy and scarcity and what have you, or technology, and these are things that are trending on those ETFs, the gap becomes mind-boggling. So we've all gone and seen what 1% does to your returns over like 30 years and what that does to your end values. Some of the behavior gap numbers on thematics and investment themes, often expressed through ETFs, will run into several tens of %, okay, which is not mind-boggling, that is mind-shattering and absolutely wealth destructive. So yeah, very efficient investment vehicles, but how they are used by investors and who launches them and when is massively problematic.
Yeah.
I think that probably flows quite nicely into your next question, Cam, which is on social influences.
Yeah.
So I don't think this is just a new thing. It's just taking a different shape. So in the past, you'd stand around a braai and you'd talk to friends, and friends would say, well, this is doing really well. I'm making a lot of money on gold, or my Bitcoin's doing really well. And then you feel a bit of FOMO and you start wanting to go into gold or go into Bitcoin. And then you do so in 2018 when Bitcoin was 20,000 and it drops back down to under 8,000. Of course, now it's 100,000. So that's a bad example. But that's an example. Now we're just seeing it at scale. We're seeing it at scale with the advent of all these social media platforms. And I think we can, and many of the opinions there are wealth destructive. Some of the opinions are actually very, very good. So there are a couple of influencers which we're keeping tabs on who are excellent. They're saying a lot of the right things and they're probably helping people get towards a better outcome because of what they're saying. So I think it's really up to us to try and work with those influencers who are professionals at influencing. And we, as investment professionals, we're not actually as good at influencing as many of those people are. So my view is we need to try and work with them. And one group that we're trying to encourage to work with us for positive change are sports professionals. Unfortunately, right now, sports professionals are being paid really, really well by sports betting companies, which is, I mean, if you gamble, it's somebody once described it to me as a tax on the mathematically inept. So you are over time going to lose. It's a statement of fact. You're not going to win. But these sports betting companies are bringing in not millions, but billions of rands a month from South Africa. It's horrific. And so I think if we can get our sports professionals who are leaders in the community to start encouraging the rest of our nation to do financially constructive behaviors, I think that'd be a good start. So we've got to find ways to work with influencers rather than treating them as an enemy, because they're not. A lot of them are good.
Yeah. All right, gentlemen, thank you for the session. I think it's time we wrap up, but I'm going to ask you the question that I put to Jeff earlier and Adam, but key takeaway. Brian, would you like to take us away first?
I basically have nothing to add to the very important thing. One is the diversification underpins all of this, and second one is just that composure. It's very easy to talk about investment composure, when things are stable, but it increasingly our impulse to act as human beings. You've got clients that are small business owners or built business empires. They have profited from making high conviction decisions, right? They've done well by assessing risks. It's very, very hard to go and tell confident people to sit on their hands and do absolutely nothing, because it's counterintuitive. But that is possibly the best advice you could give anyone right now, and at almost all times. Stick with the strategy.
Yeah, I hear you. All right. Carl?
Well, I'd say the main takeaway is to get more comfortable with uncertainty, because the volatility and the uncertainty is going to get more, and it's not going to change, because it's not about Trump. It's just where the world is at this place right now. We're coming to the end of several major cycles, and it's a time of change. I mean, monetary systems are changing, geopolitical systems are changing, and that's going to throw the markets in many different directions. And once again, it's going back to what Brendan says, it's keeping diversified, so that you benefit from whatever happens. And somebody who tells you they know what's going to happen, they're lying, because nobody knows. There are just way too many variables. It's the most complex system. Going through a phase change is pretty much mathematically impossible to properly predict.
Yeah. And Alex?
Cam, this is very boring because we're all saying very much similar thing. For me, it's really about a plan. So if you can get a plan going for life, for the whole of life, and then rationalize that down to a financial plan that fits into that life plan, that's probably the first place to start. Then the second thing is make sure that you have your asset allocation right and take into account all the assets you have, not just your investment assets, your property assets, your bank account assets, your business interest assets. So all too often entrepreneurs are way too heavily exposed to one business. If their one business doesn't work out, then often spells disaster for them. And then the third one is make sure there's no concentration risk within your portfolio. So once again, diversify between countries, between currencies, between asset classes, between fund managers, because even very, very bright people get it wrong. And that's why I really believe we've got one of the best ICs, probably globally, but certainly in the country. I think we've got the best IC. We've got so many diverse thinkers, which is amazing.
Yeah. Thank you, Becky. I know you got kicked out, but you're back in. So we're just wrapping up with a key takeaway.
Oh, wow, that's going to be difficult for me now since I missed the last 15 minutes. But yeah, I think it was a good session. Yeah, but if there's anything specific my way, then I'm happy to answer it. Yeah.
All right, then I'll wrap us up and say thank you so much for everyone for joining. I really appreciate those of you. There's still over 60 people that are here, even though we've run over half an hour. So one, I'd like to thank the panelists. Thank you all for joining and sharing your opinions. Thank you to everyone who joined. Really is great having you here. Like we've all mentioned, if there are any further questions, please pop them through to any of our socials or emails, and we can we'll get back to you. But again, thank you so much. Thank you, everyone. You must have a great rest of your Wednesday.
Thanks, guys.
Thanks.
Thanks,
Cheers.
everyone.
Bye-bye.
Cheers, everybody. Bye.